Thank you very much for the introduction forum. Uh, Thank you everyone for joining today evening and giving us opportunity to share our views on a very critical topic of what are the merits of investing in hedge funds in the current market environment. Just to give you a little background about me, my name is Ajay Vaswani, and I head the business development function at ITI Alternate Investment Funds. And today we have with us Mr. Rajesh Bhatia, who is MD and CIO of ITI Long Short Equity Fund. Rajesh has more than 30 years of experience in managing equities. Out of these 30 years, more than 14 years he has been managing the long short strategy. This makes him, in fact, not the only, if not the only one, that definitely among the very few who have such kind of experience in managing the long short strategy in Indian markets at least. So I would like to invite Rajesh now to take it over from here and throw some light on the topic today, merits of allocation to hedge funds in current market environment. Rajesh, over to you.
Right. Thank you, Ajay, and welcome everyone. Thank you for the opportunity. Thank you for taking your time to listen to our topic in our fund. I think Ajay has kind of talked about a little bit about my background. So I'll just dive into the topic itself, which is why should you look at hedge funds or a long short equity fund in the current market environment. So what I want to tell you is that basically, if you're an Indian investor, you are facing a dual challenge. What are those dual challenges? The first is a lack of return in fixed income, right? So this is not only what we are seeing, but when we speak to a lot of our high net worth clients, they also are expressing these dual challenges that they are facing. So in fixed income, what is happening is that if you give money to a liquid fund or a fixed deposit, you are making anywhere between 3 to 4.5% pre-tax. That's an inadequate return, given that the inflation rate itself is about 5 to 6%. In effect, you are making a negative real rate of return, right? Now, the purpose of investing is that you can make a return which meets or exceeds the inflation rate. So you are able to make as much as the purchasing power or retain the purchasing power, or in fact, grow it. But in this case now, you're actually losing purchasing power. So by investing in fixed income, it is not giving you an attractive return, at least in this current environment. So that's the first challenge that Indian investors are facing. By the way, this is not only a India phenomena. Today we are synchronized with the world. And as we speak, the amount of bonds which have a negative yield, right? Which means you actually have to pay money to buy that bond eventually, because your negative rate of interest is negative, is totaling about 16 to 17 trillion dollars, very close to a all-time high in the history of mankind's civilization. So this is a challenge of low interest rates globally. And as you guys are familiar, this is a very important thing to understand why this is happening. As students of finance or practitioners of finance, you must know that this has been triggered by unusual amounts of money supply that has been pushed by the central bankers of the world, specifically the developed world. So there's a lot of money supply that has been pushed into the system. We call that now quantitative easing 2. The quantitative easing 1 started post the great financial crisis of 2008, and now post the COVID in 2020 is that quantitative easing 2 experiment that has started. The result of that large expansion of money supply has been that interest rates have come down. As I pointed out, globally today, 16, 17 trillion dollars of bonds are yielding you a negative return. And, it's kind of making that space a little unattractive. The second challenge that Indian investors are facing, and by the way, again, that is true for across the globe also, is that equity market valuations are at peak levels. Global equity markets and in Indian markets are at an all-time high. Now, the challenge is that for people who want to make fresh investments, they are fearful. How do I make an investment in equity markets today, given that, if I put money in right now, it's at a high level, I'm certain to lose money, or at least I'm not able to want to make an attractive return. So that is the second challenge. So these two large markets are not giving them comfort to invest. So those are the dual challenges that investors are facing. Now, how are people addressing this challenge? Not only in India, like I said, globally also. So imagine if you're an endowment, a fund, a university, a family office, you're facing these same challenges. Now, typically they are moving to a hedge fund, specifically a long short equity fund. This is a global trend. The hedge fund space in the US is worth $4 trillion. So it's a very, very large market. I think the active mutual fund market in America is probably $5.5 trillion. So the hedge fund business is 4 trillion. So you can imagine that size. Now in India, it's at a very nascent stage, and that's why you haven't kind of heard as much about it. But the way large investors and sophisticated investors are solving this dual challenge are walking to a long short equity fund platform. Yeah. So that is the other thing. So what does a long short fund really do, and what are the advantages of moving to a long short equity fund, right? So while there are many types of long short equity funds, and in India, a lot of them are focused on absolute return, right? So, and there are some which are trading oriented, some which are quant oriented. These are different approaches to making money. But I can tell you what we do, which is the ITI long short equity fund, right? So what we aspire to do at ITI long short equity fund is that in case a market declines, the fund will attempt to protect the downside, right? And in case the market goes up, we are trying to make an equity type return. What is the result of that? That over a full equity market cycle, which involves markets going up and down by 20% on the upside, 20% on the downside, over a full equity market cycle, we aspire to beat even the Nifty with much lower risk and much lower volatility. Now, you know that beating the Nifty, it's not an easy task. 80% of mutual funds in India and America actually end up underperforming the Nifty. So if you are able to do that with much lower risk and much lower volatility, that's a very, very strong value addition that you can get from a long short equity fund. So, what I'm trying to tell you is that this asymmetric return profile, which is not losing money in case the market goes down and making money when the market goes up, it's asymmetric return, right? Is one of the best ways to compound wealth over the long term on a risk-adjusted basis in a time like this. That is the key message I want to give you. See, because what's happening is that typically long-only funds have it's a one-way bet, right? Either if the market goes up, of course you make money, but then you're bound to kind of lose money as well. So this downside participation, downside protection, becomes an extremely important virtue in a long short equity format. Now, I can tell you that while I've been managing long short equity funds for 14 years, and I was there in 2008 to 2012 as well. If you remember, 2008 was one of the worst years in 30 years in the Indian equity markets. Market fell 55%. We were there for part of the year. We lost 1.5%, right? And similarly, in 2011, the markets fell 25% in that calendar year. During that entire year, we lost less than 2%. So, and fast forward to our current fund. If you kind of look at our 3.5 years since we have started the fund, there were two drawdowns or declines that happened in our fund period. One was when the ILFS episode took place, where the markets kind of declined by 11 odd percent. We declined by about 2 odd percent during that time. The second was during this coronavirus episode, right? When the market kind of fell, I think from peak to bottom, it fell about 35-40%. We were in fact able to make money during that period, although marginally, but we were able to make money. I think this ability to protect downside is an extremely important virtue of a long short equity fund. And that's how you should measure long short equity funds as well. If I lose as much as the market, then I'm like a long only fund. I'm not a long short fund. But if I'm able to protect capital and give you an equity type return, that is a strong value add. And I can tell you, I speak to a lot of high net worth individuals. They are very, very happy with making this kind of an asymmetric return in their portfolio, especially given the current context. Can you go to the next slide? Right. So, why do I think that downside protection is important? Now, I can tell you, downside protection is one of the most underappreciated investment principles, especially as I see it in India, right? And so why do I say that, right? So a lot of us follow Warren Buffett, but do you know what his first principle is? Rule number one, don't lose money. Rule number two, never forget rule number one, and why does he say that? So I suspect he says that because of the mathematics of decline, right? What do I mean by that? So let us say if you have 100 rupees, if you lose 50% of it, you're now left with 50 rupees. Now for 50 rupees to go back to 100 rupees, you require 100% return. So I think it is overemphasized when you are evaluating funds. What is the return upside that is given? You must also look at what is the kind of downside protection I've got in that fund, right? So I want to illustrate this with that table that you can see. There are two portfolio for illustration purposes, portfolio 1 and portfolio 2. Please notice the math. While the portfolio return 1 has a higher return on the upside, it has a slightly higher downside as well. And to the effect that the portfolio 2, which is a more sober and a consistent return profile, and which is able to protect downside, eventually ends up, at a better place, right? So the conclusion of that is, it is far more important to avoid losing years rather than to have large winning years, right? So protecting downside is an extremely essential condition to compound wealth over the long term. So if you are thinking, I want to grow my wealth over the long term, people think, how do I make the best upside return? I think it is equally important to question whether I'm going to lose my part of my capital. Because if you do not lose as much and you continue to chug along, you'll become extremely wealthy, right? So I think that is an extremely important component of investing, which I think is extremely underappreciated. Ajay, can you go to the next slide? Right. So let me give you another example of this downside protection. I think it's an important concept, which I hope I'm able to communicate very clearly. Now, if you had given money to a fund manager in 2008, right? Jan 2008, India experienced one of the worst years in 30 years, as I pointed out, right? Did you know that to come back to the 2008 index level, it took 6 years? So you actually had 6 years of no equity gain. Now imagine what it does to your compounding for 10 years. It damages your compounding. So it kind of speaks to the concept I spoke about, which is it's far more important to not lose money, and that is an essential condition to compounding wealth over the long term. So this is what I want to kind of emphasize. Ajay, go to the next slide. Yeah. So while I kind of say this, I want to talk a little bit about, our fund. Of course, we have done this. We have been doing this for the last 3.5 years, and I've been doing this for the last, 14 years. When I started this fund, I put in my family's money. 20 crores of the money in the fund is my family's money. 80 crores of the money is from ITI, Investment Trust of India, the firm. So 100 crores of the money is ours in the fund. So we are eating our own cooking. We have skin in the game, right? So we are so convinced that this is a good way to compound wealth over the long term, that we are showing that by putting our own money in the fund, right? And when I looked at this opportunity, I said, while this is a $4 trillion market in America, it is at the ground floor in India. There are very, very few handful of long short equity funds or hedge funds. And do you know that some of the best fund managers in America are all hedge fund managers? So whether it is George Soros, Seth Klarman, right? Seth Klarman is the guy who's probably written the best book on investing called Margin of Safety, right? Stanley Druckenmiller, right? Michael Steinhardt, Julian Robertson, right? All of them, Bill Ackman, even the two fund managers who joined Warren Buffett were ex-hedge fund managers. So a lot of talent on Wall Street actually becomes hedge fund. They eventually gravitate to becoming hedge fund managers, right? And so I thought that this is, such a great opportunity. And this value add of making equity returns with capital downside protection, right? Not capital protection, downside protection is a concept which India doesn't have, right? And there is an opportunity to kind of create a franchise in the Indian market. So we aspire to add value to Indian investors. That's really our dream. That's really our goal, that we can add value to Indian investors by offering and successfully managing a product like this for the Indian investor. So why should people come to us? One is, as I pointed out, I've been doing this for 14 years. Long short equity fund management requires a certain skill set and a certain risk management framework, without which you will not succeed in this business. People are trying to do this business. A lot of people don't end up getting the results that they desire. But I have done this for 14 years. What that means is that I have learned the investment processes that are required and the risk management processes that are required to succeed in achieving these objectives that I spoke about. The second is we have a track record of low losing years. So this value addition that I'm talking about, and that's how you should measure one hedge fund against the other. We have a 14-year track record of the same that I'm talking about. We have a team, a full-fledged team, an experienced team, which only looks at this product. We want to excel only in the long short business. So we have not gone to long only fund, do something else, nothing. We want to focus and excel on this one particular product, and the entire team is focused on delivering excellence in this long short equity product. And lastly, as I talked about alignment of interest, we have our own money. 100 crores of the money in the fund is really ours. And so there is great alignment of interest, as we speak. Ajay, can you go to the next slide? Right. So, remember I told you long short equity funds are for asymmetric return profile, which is you participate on the upside and make an equity return, protect the downside, and over a full equity cycle, you aspire to even beat the Nifty index, right? And yet that the result is achieved with much lower risk and much lower volatility. So you look at our risk statistics that we have. Our beta of the fund is a fifth of the market, which is a measure of volatility of the fund. Our Sharpe ratio is fairly healthy at 1.92, over twice that of the market. And look at the standard deviation. So these are risk statistics, but in essence, it's telling you that we are taking lower risk and lower volatility to generate equity type returns. And that's, I think, is an extremely important facet of a long short equity fund like ours. Ajay, can you go to the next slide? Yeah. So I want to kind of walk you through a bit of the investment process. See, we are a fundamental long short equity fund. We make decisions on a company by company, which is called bottom up basis, as well as we bring a certain top down understanding of the markets, of where are we on the economic cycle, where on the valuation cycle, where are we on the enthusiasm cycle, etc. So both of these skill sets are necessary for us to navigate the markets and achieve the desired results that I'm speaking about. We are a AIF3 product, right? Under the SEBI guidelines, alternate investment fund category 3. We are taxed at the fund level. And this is the way that we manage our money, right? So if you look at it, we have two components of our portfolio: a strategic component, which is the investment in cash that you see, and a tactical component, which is thematic exposures through futures. That's the tactical component that you see. So let us say out of the 100 rupees that I have, 50 rupees is in my strategic long book, which are typically good long-term bottom-up ideas that we have in our portfolio. I can give you some of my names that we own in our portfolio. It is HDFC Bank, HDFC, Infosys, Larsen & Toubro, Infotech, SBI Life. It just gives you a flavor. Basically, some of these companies are leaders in their businesses, high ROC, high ROE businesses. But two other components that we look for is longevity of growth and attractive valuations. So, these are growth stories for the long term. And the prices that we are paying for these stocks are, not outlandish. This is a portfolio that we don't move. So this is our strategic portfolio. In the last 3.5 years, we haven't sold or exited any position. We've trimmed some Larsen & Toubro Infotech, but we haven't sold or exited any position. So we are long-term investors in this. And I mentioned this because, like I pointed out, we are a tax structure, right? So one of the perceptions of AIF3 structure is that it may be a high tax entity. While that may be true for other funds, such as an absolute return fund, because of the type of strategy they run, that's not necessarily true for us. So if they are long-term holdings, I incur long-term capital gains when I sell that opportunity. So this is my strategic portfolio. I want to quickly come to the tactical portfolio. I have tactical longs and tactical shorts. So these I buy through the futures. So let us say, if I want to buy Ashok Leyland, let us say, for a shorter period, these are not 10-year stories, but if I wanted to buy Ashok Leyland for a shorter period of time, I will kind of add Ashok Leyland in the futures market. Or if I felt IT services is a fantastic opportunity, apart from my strategic holding, I need to add in my tactical book, I could buy Mindtree, or I could buy Tech Mahindra, or any other stocks. So again, those are fundamental oriented, but they may not have 5-year catalyst. Now, I can tell you the advantage of having a tactical book. So, let's say today IT is doing well. I can increase that weightage very, very quickly because I'm investing in that through the futures market, right? And God forbid, or God willing, if IT comes to an exhaustion level, and let us say banking becomes more attractive, I can very seamlessly move to banking and become overweight banking on a very, very quick basis, right? Whereas typically long-only funds, they struggle to change their compositions, very quickly. Typically they run their positions for much, much longer. But whereas I'm able to take advantage of the shorter-term changes that may take place tactically in sectors as well. Now come to the tactical short book. Look, I think this is an added canvas of companies that we can make money from against a long-only fund. A long-only fund, let us say if it believes, autos are toast, right? Some parts of autos are toast because there is disruption that is taking place because electric vehicles are here, right? What can they do? They will say, let me not buy some of these auto companies. But as a fundamental analyst, I can short some of these companies and make money from there as well, right? Now, I can tell you that some people would like to believe today we are at the cusp of one of the largest disruptive environments for businesses. So I mentioned electric vehicles disrupting the automobile business. Today, Tesla's market cap is greater than the top 10 ICE engines or conventional car manufacturers, right? If you look at today, some people are arguing, why are banks not performing in India? Because there is a rise of fintech opportunities. And today there is worry that whether banks' fee businesses can get disrupted by these fintechs, right? You are already seeing the effect of e-commerce on retailing. You're seeing the effects of OTT platforms like Netflix, right? Or Amazon Prime on broadcasters. So there are many such disruptive elements that are coming to businesses, and which means that some businesses economics are going to decline. By having a short book, I extend my skill set to taking advantage of what I can short as well. Also, theoretically speaking, let us say if I'm long IT, right? Let us say I'm long Infosys and short a company which I think is toast, right? Let us say we were short Jet Airways, right? Theoretically, I have reduced the beta of my portfolio and have enhanced alpha. So that is another upside that we get to having this sort of a book, a long book and a short book. And there's a second component of that. So first, my job is first identify which companies I want to go long on and which companies I want to go short on. That's the skill set that we bring in. The second skill set that we bring in is how do we change the mix of these longs and shorts to navigate the markets effectively. So let us say in an episode like the coronavirus episode, markets are falling 35, 40%. I can reduce my equity exposure to as low as 0. And the corollary to that is, in case we feel the market needs to market is very attractive and can, we are looking at growth for the markets, then what we can do is increase our equity exposure. Of course, we are doing that on a dynamic basis. And like I pointed out, our flexibility or our time to kind of navigate this is extremely low, which makes it, fairly nimble, in kind of managing these positions. So, in summary, this is really what I wanted to kind of tell you. Ajay, next slide. Right. Okay. So I think that's really the conclusion. This is This is in effect really what I wanted to kind of communicate to you. And I'm happy to answer any questions that any of you may have.
Yeah. So Rajesh, here we complete our presentation. In fact, discussing a long short strategy in itself is a full detailed thesis. Whatever you could have actually shared in 30 minutes, best is already shared. So there are some questions which are coming up. We will start taking them now. And so Himanshu is asking, Himanshu is asking that why is it called investment in cash even though it is invested in blue chips? Okay, so Himanshu, see, these are the two different investment baskets, two different invested into two different ways. Investment in cash means you go ahead and invest money by buying stocks in your demat accounts, and here whatever position you make on the tactical portfolio, that is through futures. So when you go ahead and invest in this strategic long and fixed income, you are putting your cash and doing the cash investment. You buy for building the futures tactical portfolio. You are buying through futures which are derivatives. So you have to keep some margin from this strategic long stocks or fixed income, and then take a position through futures for building the tactical portfolio. This is the reason this is called investment in cash. I hope this clarifies. If you understand the difference between the cash investment and derivatives investments, you will be able to understand what point I am trying to make. What is the expense ratio of this fund? Ganesha is asking. So, Ganesha, the expense ratio of this fund, there are different kind of share classes which are available for the investors to invest. So we have share classes where 1.5% is the fixed management fee, and then there is also a performance fee share of 15% after the 10% of hurdle. Okay, and that is without catch up. So that is the expense ratio. To know more about this fund, what I would do, I would at the end I will put my contact number and my colleague's contact number from our business development team, wherein you, if you want to get further detailed presentation of the product, so we will be able to send you that. What another question which Ganesha is asking is, what are the risks or limitations of this fund which the team perceives compared with other type of funds? So Rajesh, you want to take it?
Yeah. So I think, see, typically, of course, this is a equity fund. So typically, I mean, all the risk with an equity fund should be applicable, but that's on a I would say the theoretical level. The practical risk to the fund that I see usually that happens is, if your idea is to protect downside, sometimes that means sacrificing the upside, right? So let us say an election result are going to come right now, and you don't know what the outcome of that event will be. But if it is favorable, the market can go up 5, 7, 10%. But if it is unfavorable, markets can go down by 5, 7, 10%. Now, if you have stated that the objective is that we want to protect the downside, right, then chances are that you will not go with an aggressive equity long position. You'll typically go with a more modest. You'll still go with an equity position, but you may go with a more modest equity position than a full equity position. So it's possible that in the pursuit of protecting downside, there will be times when you will sacrifice the upside. But that's embedded with the philosophy of the fund that you're running. The second risk that other hedge funds run, which are aggressive, now it depends upon, like I pointed out, I think risk management is an extremely important component of a long short equity fund. Some people, demonstrate their conviction by being net short 40%, and all of that, right? And of course, if you are net short, which is negative on the market by 40%, if the market goes up, you are actually losing money. But we don't do that. We are in a decline like that. Even if you're convinced that there is a big decline that is coming in, we are happy to, let us say, be closer to zero net equity exposure. Or even if we feel that the markets can go down but dramatically, we would rather buy puts, which limits our downside. So we are happy not losing money when such a sharp decline takes place, rather than try to make an extra return or a massive return when the markets are declining. But that is a risk that can happen with other funds. But we are at many levels, we are fairly cognizant of how to take risk. Somebody pointed out, are these blue chips that you're investing in? Well, the nature of our portfolio really is such that we are managing risk at many levels. Even the type of companies that we invest in, typically most of the type of companies that we are investing in are predictable multi-year growth stories. That's really our theme of what we are long on, right? And because these are multi-year growth, quality growth stories, our risk gets adjusted to that extent. Now, I told you another filter, that we are not willing to pay high prices for these opportunities. That's another filter that if we are buying quality, predictive, multi-year growth businesses, and if we attach a certain price discipline to it, that's another way to reduce downside. Now, I told you that we have a diversified portfolio of companies on the long and the short side, right? Typically, we run 25 positions on the long side, 10 positions, 15 positions on the short side. That diversity is another way to reduce risk. Liquidity, right? So we run extremely liquid portfolios. We focus on the top 220 odd companies. Again, that becomes a way to reduce our downside. Then there are many other filters that we look at. What percentage of our portfolio is linked to interest rates? What percentage of our portfolio is linked to commodity inflation? What percentage of our portfolio is susceptible to rupee? Well, I got a little technical here, but what I'm saying is we do a fairly good understanding of risk in our portfolio to kind of arrive at that's the portfolio construct that we need to have. So I hope I've answered the question. But the primary risk that I kind of think about is it's possible that I may have to give up some upside, in case I've taken the mandate that I'm going to protect downside as well. So that's really, where we will be. I genuinely believe that, and I hope that's true for the future as well. I genuinely believe that investors can come back and say, I don't think I made a great return in your fund, but I don't want to, answer to anybody who says, boss, I lost money in your fund. So I would rather have the first than have the second.
I hope, Ganesha, your answer was satisfactorily answered. The question was answered. So we'll move to the next question. The question, Pankaj is asking a question. So you mean 50% of the fund is always in long-term and fixed income instruments, and rest 50% into tactical portfolio dynamically? No, Pankaj. As far as the cash component is concerned, I have again put up the chart on the screen for you to understand. The 100 rupee cash which a fund receives, out of that, the ballpark figure, 50 goes into the stocks which we hold for a longer period of time in our demat account. We buy them in cash, and another 50 rupees gets invested in fixed income. So this completes overall investment which we do in cash in the fund. And this tactical portfolio is built by taking positions through futures by using derivatives. So for making these positions, we have to keep some part of this cash investment as margin, and we get these positions built, so that as you know, that we can go up to 200% of the NAV of the investment. So if we have 100 rupee for investment, we can go up to 200 rupees. So the another 200, under 100 part which we built, that is built through the derivatives. I hope this answers your question. Now we move to another question. Shikha is asking, does investment in cash means cash segment? Yes, it is the cash segment, correct? Cash segment and the derivative segment. So you are correct. Then Sapna is asking, please explain the 200% NAV. Okay, so this 200% NAV, I would again repeat this under category 3 AIF. You can go ahead and invest up to the 200% of the NAV. That means if I have 100 rupee for investment, you can go ahead and invest up to 200 rupee. So
in equity.
In equity. And why? How are we able to do it? We are able to do it by using derivatives.
We don't. But while we are theoretically able to do it, that's the regulation. We have pointed out that the regulation says that our typical gross long exposure and short exposure total combined is typically anywhere between 80 to 120%. Maybe you can stretch that to 80 to 130%. This includes longs as well as shorts, right? So the breakup, let us say, theoretically is 50 rupees in long, 50 rupees in tactical long, and let us say 20 rupees in tactical short. This makes the gross exposure 50 rupees in strategic long, 50 rupees in tactical long. Now that gives you 100 rupees of long plus another 20 rupees of short. That is 120. Although the net exposure, as we define it, is this 50 rupees of strategic long, 50 rupees of tactical long, minus 20 rupees of short. Therefore, it is about 80%. So our gross, while we can go to 200, we are typically at between 80 to 130%. So, and typically our net, our last 3.5 years net exposure has only been 55%. That's the average. And typically it is between, I would say, 45 to 65%. When we get bullish, it goes to about 80 or even 90%. And when we are bearish, it comes down to, let's say, 25 or even less than that. I hope I've answered that question. So we are not, while we can expand and leverage the book, this is again a way for us to measure risk and keep risk in check. We don't leverage the risk to a higher level in the portfolio.
Okay, so Rajesh, Wasim also asked the same question. Do you leverage since it is a category 3 IF? I think this answer suits the Wasim's question also.
Sure.
Now, after that, I have multiple questions which I see on the taxation bit, wherein they're asking what is the tax structure for on this fund. So I'll just take up that question. See, in category 3 AIF, the tax is at the fund level. And let me put at the
and the investor doesn't pay tax.
Yeah, and the investor does not have to pay any tax. So taxation on category 3 AIF says that the tax is at the fund level. Whatever return investor gets in the hand is tax free for the investor. They do not have to go ahead and pay any tax on the return which they have made in their bank account, received in their bank accounts. Now, what is the kind of tax which is applicable in this kind of a fund? We have a blend tax of around 20 to 22% is what the guidance which we give for the taxation. Our actual experience for last 3 years is around 20% of the tax. And in this year, if we would see financial year till date, that tax is even lesser than what the 10-20%. Now, how this tax is calculated, as you saw, our investments are into various baskets. The investment is into the strategic portfolio. We invest in stocks, equity shares for the long duration. So if we invest there for 3-year plus period, there's long-term capital gain tax which gets attracted there. Fixed income, we have parked money into liquid funds. There also, if it is the investment, the tax is long-term capital gain tax. So whatever return which we generate on the strategic long and the fixed income part of our portfolio, that attracts around 10 to 11% tax. The tactical side of the portfolio, where we build through derivatives, whatever income gets generated there from that portfolio, that is fully taxed. So around 42% is a tax on the income which we generate from our derivatives portfolio. Now, if you would see the breakup of the kind of returns which we have made since inception, so by around 71% return we have made since inception in this portfolio. More than 60%, around 60% return is generated by strategic long and fixed income. So because of that, as most of our return is coming from, major return is coming from the long-term the income which is charged as a long-term capital gain tax. So the overall blend tax comes to near 20%. There are certain, there's a perception in the market that on long short funds, the tax outflow is higher. It is 40% tax. See, it happens in those kind of funds where the income, the most of the income is coming from there's a trading income. So most of the income is coming from the derivatives. positions. That's where the taxations are 40%. As far as our the strategy is concerned, here the blend tax comes to 20%, and that's what we are putting as a guidance in our product presentation also. I hope this clarifies the answer. I had many questions on the taxation bit.
So I'll take a few questions here, Ajay. Does your fund have exposure to private placements in global markets? Which is, if the question is, do we buy private companies in the international market? The answer is no. How is money allocated towards margin and mark to market? Well, we pledge the strategic portfolio and we pledge some fixed deposit. And of course, there is some cash that is allocated for mark to market for trading in futures. And, the leverage can, given our ability, the leverage can be much, much higher than what we are taking, probably multiple times of that. But clearly, because we restrict our gross exposure to 100 and 120% that, as I mentioned, we don't need to allocate as much capital towards margin or mark to market. Standard deviation is less than compared to benchmark. That's because of less risky exposure in portfolio, and hence it must be impacting returns. So is it safe investing? Actually, there are many questions that you asked in that one question. Standard deviation actually is a good, healthy sign that the volatility in your portfolio is less than the volatility of the benchmark, right? And of course, that happens because of two functions. One is that our stock picking is good, and so there the beta of our shorts, beta of our portfolio is lower than that of the market. And second is the fact that when markets lose 35-40% and we don't lose, that is also gets reflected in our standard deviation, right? Because we are not as volatile as the market. So markets go up and down at a far greater rate than we do, and that's also because of our tactical navigation of the portfolio across the market cycle. I've answered. There's a question on percentage of funds. I've answered that. It's not a large part of our portfolio that we need to kind of allocate towards margin and mark to market. How did you manage the Qubit drawdown? Was it post-event or pre-event risk management? Well, I can tell you that the best returns are made in investing when you're able to see something ahead of the market. That's an investment principle there that I'm telling you. That if your understanding or analysis gives you the wisdom to see something that is ahead of the market, it may be a market event or it may be the outlook for a certain sector. That's why having a genuine fundamental understanding of businesses is such an important thing, because then you're able to see the prospects or the risks a little ahead of what the market is. Given that context, let me tell you that COVID, like other large risks that come to market, did not come by stealth. So what I mean by that is, even the great financial crisis of 2008, people were shorting the housing market in 2006, 2007. So people knew housing was a bubble. It just broke in 2008, right? So even coronavirus, our markets fell the maximum in March. But the coronavirus came to China in December. China locked its economy down in January, right? Our markets started to tell you that I'm worried about coronavirus in February. By February, it had spread to South Korea, Japan, Italy, Germany, UK, and even I think it had touched California in America. But Indian markets did not respond to that for whatever reasons. People thought, SARS did not affect us. We are too hot and humid. Whatever reasons, they thought India will not get impacted by it. But we saw that as a very significant risk to the markets, because if you're going to shut down an economy, if you're going to shut down businesses, that has significant repercussions on profits of the country, right? So while we saw that as risk, this is an opinion that we had, and we are all the time on the lookout for what is the large risk that can impact markets. But the second is our process. So, I can tell you that when the market started declining, we have an automatic process of reducing our exposure to equity as that happens. I want to show you this table. This is what happened in the COVID crisis. On 23rd February of 2020, market was close to its all-time high then of 12,000 odd. And our exposure to equity was 78%. At the back of our mind, we knew COVID is a huge challenge and this is going to lead to a collapse. On 24th, which is one day later, we reduced our equity position to 35%. Remember, I told you that we are fairly nimble in navigating the markets, right? And that's a value add that kind of we bring to the table because of a long short equity fund. So that 78% became 35%. And as the market kind of kept dropping, our equity exposure drops. What I'm telling you is that we have done this for a long period of time. If you want to successfully do something repeatedly, you have to have a process around it. So our process is, apart from our opinion and our understanding of the top-down risk, we also navigate the market through these processes. Right. So I hope I've been able to answer that question. Is it a good time to invest in equity markets in the current market scenario? Well, I can tell you that given the environment that we are in, look, a lot of you are wondering why are equity markets at an all-time high and why are they going up like this without any correction? You must know that these are engineered markets. This has been caused by the unprecedented amount of money supply that has been pushed into the global markets by the central bankers, right? And even the central governments are extremely keen to jumpstart economies, right? In the US, the fiscal deficit of US this year will be as high or higher than what it was since the Second World War. So that's the kind of government expenditure that you're seeing. So of course, the impact of that is rise in asset inflation. But these are engineered markets. You are also having a market which is 70% retail, a lot of ETF money, and a lot of automated trading that's happening. This is a recipe for herd behavior, right? What I mean by that is what goes up with that kind of level will also, when the risk aversion comes, come down at an equally sharp pace. Therefore, we think a hedge fund is one of the best ways to participate in this equity market, because given the interest rate environment, I've told you it's never been so low in the history of mankind. If it's never been so low, how can you forecast the future? So this rally may extend more than you anticipate because you have not seen this in the past. But what goes up must come down at some point in time. So whenever that risk manifests itself, you will have an equally sharp drawdown. So how do you navigate low interest rates, unattractive interest rates, and extremely extended equity markets? Hedge fund is one of the best models which can protect your downside and yet keep you participating in the equity markets. So, I hope I've answered that question. There is a view of the equity market, but I don't know if we have time to go through that at this moment. What is the AUM of the overall fund? As we speak, we are 400 crores and growing. We have grown, more than 3.5 times in the last 16, 17 months. So a lot of the growth has really come in, as we speak. Okay. Any other questions I can take? Is 72% return pre or post tax? No, these are pre-tax returns. We can give you the post-tax returns if we'll have to compute them for the current year, but we can give that to you if you want. Any other questions I can take? I think we've answered most of them.
In case you need a detailed presentation of the product of ITI Long Short Equity Fund and want to know more about it, you can contact Karishma Mordani from our sales team. I have put her mobile number and email ID in the chat box. We do the fund presentation on every Friday evening. So in case you want to go through the detailed product presentation, we can send you the Zoom link invite for attending it on Friday. You can contact.
Vishal Gupta has asked me on a lighter note how to be a hedge fund manager. So it's not very different, Vishal, from being a investor. I think there are two aspects to this. One is your temperament and your how you are as a person, right? Uh, which is use a lot of common sense. Uh, you know, uh, keep your head. Those kind of things, emotional stability. Those are the personal characteristics that you need to have, right? And be truthful to yourself. I mean, those are some of the virtues that you need to become a genuinely good investor, right? And the second is the knowledge or understanding of markets and companies. There is no other substitute. There's no other way that you can do it except by sitting down in a room, reading and thinking. That is the only way to become a good investor. I mean, not listening to too many people, but there are already some great books written on investing. Picking up an annual report and reading it, thinking about businesses as to how they're evolving, what has created wealth in the past, what will create wealth in the future, being inquisitive, asking questions. That's really the way to become a good investor. We are also learning, as we go along. And this is a business, fortunately, which keeps us excited because you're always learning. We are always embarrassed as to how we were just 3 years ago or 5 years ago, how much we didn't know. And I think if you feel that way after 5 years, you're on the right track.
Mr. Rajesh?
Yeah, go ahead.
Yeah, at the outset, thank you for a very great presentation. Just a question is, you said that there's a cash position, basically on the stocks, right? So just wanted to understand when you say shorted the futures, so to what extent is this cash position taken care on the short side to protect? Say, example, you have put 100 rupees in the cash. To what extent you short the Nifty or you take care of the cash positions?
So the cash, let us say out of my 100 rupees that I have in the fund, 50 rupees is in the cash. Now,
Okay.
if a downside does take place, so let's say if I have HDFC Bank on my cash, which I don't want to sell, but a big downside is taking place in the market, I can short HDFC Bank futures, right? So it makes my HDFC Bank position 0, right?
Okay.
And on a net basis, what I'm saying is, on a net basis, I can bring down my equity position after these hedgings to close to 0.
Okay, but because that you will trigger only when you see a downside coming.
Of a significant kind, like a COVID crisis.
Okay. Okay, thank you. And does not investing in fixed instrument reduce the overall return while it definitely takes care of the downside risk?
So what I go back to what I want to achieve. I want to achieve an equity upside when the markets go up, and I want to protect the downside. Given that I'm already taking 100% exposure to equity and meeting these objectives, that's a surplus money that's left with me, which is making me money. Remember that will be very useful because it's a positive gain in case the market goes down. So let's say the market goes down by 20%, right? And God forbid my portfolio goes down by 6 or 7%. If I make 2-3% on a fixed income, on a net basis, I have lost only 4% because minus 7 will get added by minus 3, which I made in fixed income. So market goes down by 20%, I may have lost only 4%.
Okay. So you're saying whenever the valuations are stretched, you kind of balance it's like a balanced portfolio.
No, it's a little more dynamic than that. That's what balanced funds do. Like I said, we are fairly liquid kind of a fund. We can, to some extent, our process will embed that if the market starts declining, I mean, how we kind of do that, navigate that, so like COVID, right? COVID crisis, market was at an all-time high, right?
Volatility.
But we did not decide that we need to be conservative because the markets are at an all-time high. They are at an all-time high today also, right? But there is a negative catalyst for the market to decline sharply. Therefore, we need to be protective of our capital. That is the way we decide, not based on valuations alone, because I can tell you that will be a mistake. Interest rates are so low, I don't think people can gauge how high this market can go. I'm not, so because this has been unprecedented in the history of mankind, you will not know how high the markets can go either. So valuations can't be the only measure to reduce equity exposure unless you're a big fund. I mean, you're managing, very, very large corpus. For us, at least, and basically we look for a negative catalyst to change our exposure.
Okay, great. And you mentioned about Warren Buffett, but Warren Buffett also mentioned derivatives are a destructive weapon. So how are you hedging your positions while you are long on some futures or short? So because anyway, market will always return back, but the derivatives, how do you cover?
Yeah, so derivatives are a weapon of mass destruction, right? So now I can tell you, people follow Warren Buffett very, very rigidly and don't really realize what all he has done in his life. Again, I promise you, he stands for common sense. He's not telling you just buy great businesses, right? Did you know that Warren Buffett used to short stocks in his partnership years in 1965? He was shorting equity. Did you know that Warren Buffett shorted the dollar to the extent of $23 billion in 1995 or thereabouts? Please Google it. That happened through the futures market. $23 billion of short on a currency, right? He was short that time. Did you know Warren Buffett had a huge exposure to silver? People say Warren Buffett would never buy commodities. He bought commodities. Did you know that Warren Buffett had earlier said technology is not for me? Well, he bought Apple. His largest position at this moment is Apple.
Yes.
Did you know Warren Buffett has said that I never invest in IPOs? Well, Snowflake was an investment that Berkshire Hathaway made, which was an IPO. So I think people he stands for common sense and he stands for do what is attractive from a risk return perspective. Did you know he has gone on the other side of there are people who betted that the markets 20 years later will not go up. And he's written the other side of the derivative contract. So Berkshire Hathaway has written the other side of the derivative contract also. So it's not risk management is key. Doing what you understand is key. Doing things which is commonsensical and simple is key to making money.
So, but you don't take exposure to options. So your derivative portion could very well be a naked.
So what I'm telling you is, if I have 100 rupees in cash equity, or if I have a total of 100 rupee in a mixture of cash and futures, will the risk differ? I'm telling you that I'm only going to take 100 rupees of exposure, right? So whether it is a cash equity or future equity, it is an equity position only. Na?
Yes,
I'm not taking, I'm not taking, 600 rupee of exposure. I'm keeping my equity exposure to 100. In fact, less than that. My 3.5 year average is 55%. So the returns that you see of our fund is with far lower equity exposure.
Okay. Thanks so much for taking time and answering for me and for the others. Thank you.
Please. Thank you so much.
Excuse me, sir.
Yeah, go ahead.
Good evening. I have a question. I am a FRM aspirant student. I want to enter into the market risk department. So can you please guide me on which all thing I need to improve myself for that?
That's a very open-ended question. We can take that offline. You can call me and then we can talk about it. Sorry, were you able to hear me?
Yeah,
yes, Rajesh, you are audible.
Yeah. So if you can call me later personally, it's a very open-ended question. I'll have to know too many things before I answer your question.
Yeah. Okay, so if there are any questions, you can put in the chat box, or you can also unmute and ask if you wish to. I think if there are no questions, Rajesh, we have also exceeded the time. So
Sure.
I'll thank everyone for joining today evening.
Thank you.
And yeah, for knowing, as I've already told, to know more about the fund, we will be doing every Friday the product presentation we do on our ITI long short equity fund. I have given Karishma's number on the chat box. Please contact her if you want to get more information on our fund. Thank you very much for joining.